I Okay, now that we're all being recorded, we have to behave. I'm going to go ahead and call this meeting to order. Unfortunately, Treasurer Milligan has been detained in a State Board of Finance meeting that ran in conflict with this, so I'm going to be his proxy for this meeting. With that, I believe the minutes were sent out to you in advance, but I'll give you another second and then would take a motion to approve them.
I'll move to approve the minutes.
All right, I have a motion. Is there a second?
Who's our second person?
All right, I'll go ahead and second, and all those in favor say aye.
Aye.
All right. Moving into the business of the meeting, it's been probably 14 months or so since we got an update from our marketing partners. So with that, I'd like to introduce Bill and Brooke from Vines Brookshire. They are kind of the primary consultant when it comes to marketing. And then we've got Kelsey, Ike, and Alicia from NWA Brand, who is the primary team for our social media. So with that, I'm going to turn it over to Bill and Brooke and allow them to give an update on where we are as far as their work and the marketing relationship that we have with them.
Thanks, Grant. I'm going to share my screen. So,
does he have that ability?
I think I do. I'm going to try. Oh, yeah. Okay. Can you guys all see?
Yes.
So this is going to be, like we said, from 14 months ago, we're going to be looking and reviewing the work that we've done for the treasurer, and specifically the 529 plan. And with that, what I want to start off with is our mission. So when we started, the mission was to get $1 billion in funds under management. And to do that, we looked at some statistics that told us that we would need to add 7,000 new and increased savers over 4 years. We knew that because 70% of the population already saves here in Arkansas, that we would need to look at families that make over $100,000 and try to find those 23,000 families not yet saving to be able to make this mission happen. And so we started that with our goal. And we thought in 4 years, if we did all these things, we would be able to make it happen. But because of some really refined targeting and technology, actually, we were able to accomplish that goal in about May of 2020. So we reached $1 billion, and this is through a coordinated marketing effort that includes our friends, Ike and Kelsey and everybody else that's been working on this. We changed that marketing strategy. We identified new audiences across all mediums and all channels. And we adjusted that creative that we were using to meet those audiences exactly where they were. And we'll show you some of that, how that looks. We used AI to optimize these digital campaigns in real time. And the results that we saw were that $200 million in 9 months were raised, and we're still continuing to add to that every month. And we're able to attribute that growth directly to conversions, both from these various platforms. So I want to talk a little bit about the AI, and I want to talk about how we're able to directly attribute conversions, because those are some of the things that we were tasked with from the very beginning. So right now, we'll talk about our next mission is to reach out to younger and new parents and grandparents. We're going to try to lower that beneficiary age. And we've been doing that by updating messaging every 3 to 4 weeks based on our system that we call Workit, which is an AI-based brain that helps us target people anonymously. So let's talk a little bit about how we did that. And this also relates to how we're planning on doing it in the future. So this AI looks at 110 billion different URLs, and it updates those into 260 million different user profiles daily. And then it breaks those out into 25 million different concepts that are intent-based. So that's not necessarily something that's about demographics or about any kind of traditional targeting method. It's identifying people based on what their intent is by anonymously looking at how they got, the journey that they were on before they converted on our site. So we're able to drill down and see not actual people, but the kinds of people that contribute to a fund, our fund specifically, and then look back at their history and find new people that look just like them from an intent standpoint rather than from a demographic standpoint. The way we do that is by setting up pixels throughout the site. There are 4 pixels all throughout the site. These provide anonymous, PII-free, CCPA and GDPR compliant data that we use to target people. So this is completely anonymous and doesn't have any kind of personal information identification system parameters that it has to address. So the first is a site pixel. That's what we call the universal pixel. And it tells us about everybody that visits the site. We also have a conversion funnel pixel, which we're able to see as people are moving closer to enrollment. We then put our final pixel on the application when it's completed. So what we're really counting as a conversion are people that complete the application, and those are our most valuable users to build those lookalike audiences, because those are the people that are new and that are signing up for the first time. We also look at people that are existing users, and we see them coming back and donating additional funds, which are also valuable to us, and we can motivate and reinforce that. And our other partners will talk a little bit more about how that's done on various platforms, but we remind them about that in digital media as well. So we looked at these reports and we're able to determine some overall demographics. We don't necessarily use these demographics to target, but we use them to report back to you guys who it is that's coming to our site and that's converting, and how we're growing that audience over time. What we know are that the people that invest are most likely male. They could be a little bit older, and they have an income level of 150,000 or more. These are people that have, it's not a surprise to us now that our grandparents are the ones really leading the way and opening new accounts when thinking about their future, especially from the vehicles and media channels that we're using. So we can see some kind of concepts that they're interested in. Years before, looking at students, they're looking at stocks and looking at how things are developing and thinking about tuition. And we can see that we've been able to grow conversions over the past months. So you can see that the line goes up and goes down. That's not a big surprise because there are things that happen in the real world, like pandemics and recoveries and holidays and stimulus. All of those things have an effect on how people convert and contribute. But overall, we see a statistical trend of those going up over time. And our expectation is that we will be able to continue to create those going up over time in the future. Oops, wrong way. The other thing that we're able to do is we're able to look at the number of impressions that we have to buy to get the same result. And because of the AI, we're able to optimize this down to a lower and lower level of things that we have to buy. So this helps us create a better, more tightly focused message on just the kinds of people that are interested in opening an account. We see top referring sites. We're able to see the sites that people most likely came to us right before they came to us to convert. So these are sites that would cost us really, really expensive budgets if we bought any of them on their own or specifically. But because we're buying what's called remnant inventory, which means the inventory that they haven't sold directly, we're able to get on these sites at a fraction of the cost that other people buying them directly would be. And that helps us really maximize the budget that we're given to get in front of the right people. One nice story that I want to kind of share is that we're able to optimize the ads to align with audience interest. So early in the pandemic, we noticed in 1 month that leisure sports and especially foosball was coming back as a category that had a high indexing conceptual relationship to those that were contributing. So the next month, we were able to use an image of foosball, as you see here on the slide, which allowed us to capture that real-time audience interest and put it directly into ads that address that interest. That's one of the things that leads us to a really, really robust sense of creative. One of the things here as well, I want to just overall talk about just the number of creatives that we provide. It's not just one or two, it's hundreds over the course of the year. You won't be able to see any of these specifically right now, but we change and add, and the team at the 529 group provides insight and input, and then we're able to address these and send these out to people both on mobile and desktop over the course of every month. We've also used this to help us understand the media that we want to buy in a traditional sense, and it changes. And we notice that when we have a flight that runs of traditional media that's specifically targeted at the kinds of people that convert, we notice those conversions go up on our digital presence as well. We also have print in some of these places. We've been using it to target, again, our grandparents, but we also target those that are new parents, soon to be parents even. So we're using all of the resources that we have to really get in front of people at the times that they're most likely to convert for us. And we're able to see that when we run traditional advertising, we see a boost in our conversion online. We also run television, and I'd like to show you a spot that we have run a couple of times and is excellent and stars our favorite person, Dennis Milligan.
I'm Arkansas Treasurer Dennis Milligan. You've chosen names and painted the nursery. Now it's time to choose a new tradition of gift giving. Starting an Arkansas 529 Education Savings Account now allows friends and family to give a gift your child won't outgrow later. No matter how traditions change, investing in education connects us all. Save now for a brighter tomorrow. Find out more today at arkansas529.org.
So with that was in the middle of the pandemic, right around Thanksgiving, when traditions were changing for everyone. And so we were able to rapidly respond and create a video and a TV spot that was able to run to really help us reinforce the message that is critical for everything across what we're doing in terms of our 529 business, is that saving is important and starting early is the best thing that we can do. So that's the end of my presentation. And I'll be happy to take questions if that's appropriate.
Yeah, I think we'll pause. Anybody have any questions for Bill?
No.
All right, I believe Brooke is on there. I just want Brooke to jump on the screen and say hello real quick, just so you have a face with the name.
Hi, everybody. Good morning. Thanks for being here.
All right, thank y'all. So now let's turn it over to Kelsey and her team at NWA Brand and take it away.
Perfect. Good morning. I am going to see if I can send a chat here to everyone with a link. I'll also do a shared screen, but I want you to also have access to our report. So this first chat to everyone who is on the call is a link to our latest annual report. To access that, you'll need a password. It's hashtag AR529, and I'm sitting that in that second chat here. Let's see if I can also do a shared screen. Okay.
Everybody have access.
Let me know if you have any troubles at all accessing that link, but you should have it up here on the screen too. But if you want to reference back to that, you're more than welcome to do so. This page will stay live for you guys to utilize and refer back to. Are you able to see my shared screen here?
Yes.
Yes.
Awesome. So I'm going to go ahead and dive in here. As we all know, this past year held a lot of uncertainties for many families across the United States, across the globe, and especially in the state of Arkansas. And that's what we're going to focus on here today. We did run some comparisons of results from previous years and some numbers here that we'll be able to dive into to see how previous years stacked up to this year. And surprisingly, as we've all kind of noticed, people are still saving for education. We did have a drop slightly, which I will go into here in a little bit when we dive into these numbers. But before we dive into those, some of the highlights that we'll cover are going to be overviews, or an overview of the effects of the pandemic on the program, examples of initiative we have put forth, and then also creative. So I think it's really important to highlight creative that performed really well so that we can circle back on that in the future to ensure optimization and positive performance of your program. Before diving in though, I want to talk a little bit about what is a conversion and also explain a little bit more about what Bill mentioned there, which was the pixel. If you have ever been on, let's say Amazon, for example, and you're shopping on Amazon and you put something into your cart, but you don't purchase it yet, and soon thereafter, you start seeing ads reminding you to go back and finish your purchase. And I'm sure we've all experienced this. And essentially, the Pixel functions similarly, except for it's on the Arkansas 529 page, and it tracks events, if you will, on the site where, for example, if someone started to create an account but did not finish creating an account, we have ads set up to get back in front of that person and gently remind them to recall that they didn't finish their transaction so they can go back to and hopefully finish creating that account. Which brings me to my next piece here, which is what is a conversion? And there are a lot of ways to track conversions. And for us, obviously, we've defined this over the years pretty simply. It's either creating a new account or contributing to an existing account. And these triggers for us or these events are triggered for us on the final page of each process. So for example, when we are tracking conversions for a new account, you can rest assured that it is a new account created, because we're not only tracking the button that says enroll today, I think is the call to action on the Arkansas 529 website, but it's the final step in creating a new account for their child or grandchild. And so we're making sure that those events are set up properly and triggering and firing on those final buttons. And with that too, I will dive into this momentarily, but we were also able to break through on some new reporting capabilities in tracking ROI. And in this next piece here, I'm going to kind of give you an overview, and then Ike's going to take over. You will see what's called a data board. You can expand that here, but all of this is real-time accurate reporting. We're very transparent with the way that we report. So within this document, you can refer back to this at any time. We've shared with you the amount that we've spent in ad spend this year, total conversion actions, the reach of our page, ad frequency. And basically what this means is the number of times that an ad has gotten in front of a specific person. And a lot of times, depending on the service or the product, increasing frequency for many brands is a great way to increase conversion. And that's proven to be true for Arkansas 529. Almost 12,000 ad link clicks, a 0.36% ad link click through, and then you can tell here the likes and then how our accounts compared to last year. I just wanted you guys to be able to understand that data board there. And again, if there are any metrics that you'd like to see added, we can always add those onto the reporting as well. And I will stop talking and let Ike take over.
Morning, everyone. So as Kelsey mentioned, our conversions decreased over the year, primarily attributed to the fact that it was a pandemic year, but it wasn't the hit we were expecting to see. We were expecting to see it to a lot less. We were able to alleviate a lot of that, and a lot of that was attributed to the collaboration we've had on keeping our strategy in sync with what's going on in the market. So as you can see, just kind of diving into some of the numbers here, our impressions were number of impressions year over year were relatively flat. There was a 6% increase, which is not a huge jump, but we just try to keep everything consistent and to make sure that we're staying relevant and staying top of mind with our audience. One thing to note is if you want to scroll down, Kelsey. One thing to note is a lot of our targeting strategies were built off of those conversions that we were receiving. So like Bill was referring to in his previous presentation about how they're able to build audiences based off of AI, we can do this essentially the same thing with social media channels as well. So what these lookalike audiences are is they take the same attributes of people that are contributing and creating new accounts within the Arkansas 529 Education Savings Plan, and we can use that information to build audiences that help us target other audiences that are most like the ones that we know are our core audience. So we're able to build those audiences and target them in a geographical area in like the state of Arkansas based off of their account demographics, the interests that they may be searching online, their online behaviors, lifestyle, the device they're using, browser types, pretty much anything related to their browsing activity online. We can target them as well as their personal profile page, and that all of that is done within the Ads Manager platform. So the social media channels, they assume all liability for any PII regulations and any of those factors that come into play. As we mentioned earlier, 17% fewer conversions in 2020. These factors, we believe, were the ultimate result because of these audiences through the pandemic stood planning for the future. So what all that is to say is our audience is really focused. They're still thinking about their child's education, their child's future. So we've really tried to tailor our messaging to that, kind of diving into some of our messaging that we saw that has performed best year over year. Ever since we started working with Arkansas 529, we've noticed that the tax benefits message always performs just a little bit higher than everything else. You know, everyone likes seeing the tax deductions they can get at the end of the year for $10,000 per couple. We always see great results from campaigns that are built around that. Giving the gift of education. So this message is geared more towards parents and grandparents, towards making contributions to their existing accounts. So we've been able to curate the creative in a way that is, really drives an action for that contribution. And then as well as logical arguments. So things like sharing general facts about the rising costs in college education year over year, as well as benefits of saving, tax deductions is peace of mind. This peace of mind provides great content topics that drive action with our ideal audience. So kind of getting down into the tracking improvements. So in the last couple of months, Facebook has come out with some updates to their tracking capabilities that they're giving their advertisers. And one of the things we've been able to implement is a way of tracking the dollar amount of contribution events made as a result of a specific ad on Facebook and Instagram. So what we can do is we can see not only who is contributing or opening an account, but we can also see how much they're contributing as well. And as you can see here, since March of 2021, we've seen a $395,000 contributed to existing accounts of people that have seen ads or clicked on ads on social media. So we know that our ideal audience is dialed in. We know that we're targeting the right people, and those people are high value users that we want to continue to target. And if you refer back to the data board, you'll see that our annual spend was $20,000. So we essentially earned a $2,000 ROI for our annual spend in only 3 months of reporting. So just going to keep that in mind as well. So what this feature also gives us the ability to is we can identify who our ideal audience is and assign more of a lifetime value to them, but we can also figure out which audiences we may be losing, which ones are going inactive, so that we can re-engage them with a custom creative that causes them to get back into that mindset of, okay, we should start thinking about doing this again. And we can customize who we target with which message. And it really just creates more of a, takes us to the next level of performance that we're able to drive. So kind of diving into some of the best performing creative, as I mentioned earlier, the tax benefits is always a high performing. Some of our lowest cost per new account, as you can see to the left, the lowest cost per new account is a mother watching her child. So obviously that was targeted more towards a younger demographic, maybe 25 to 44 years old. So, that really trying to drive that new account conversion down. Click-through rate, we found that we ran a campaign around Mother's Day that performed really well. It gained us a lot of clicks, targeting specifically mothers with custom creative.
That one was actually similar to Mother's Day, but I think this one was in the fall. It was the focus on new mamas, specifically people who were people who had friends that were pregnant, expecting women, and we targeted those people within that circle.
That's right. I forgot about that. Thank you for reminding me of that. And just kind of going down to the bottom left, the tax benefits obviously drove the lowest cost per contribution, kind of targeting more of those older parents and new grandparents possibly to make a contribution to their child's 529 account. And then the highest return on ad spend. So this is a metric that we are able to use that the campaign automatically essentially targets our return on investment within the campaign. So this creative piece here generated the highest return on ad spend, which I believe was around $145 earned on every dollar spent. So kind of getting down into more of the audience breakdown for our age and gender. It's month over month, we see a pretty even split between male and female. However, the thing to really note here is our ideal audience is a little different than what the other channels might see. Is we actually target the majority of our campaigns to the younger demographics of between the ages of 25 and 44. And the reason for this is because we've done a lot of tracking of data and reporting, and always are seeing our highest engagement from these younger demographics, which is in line with the Arkansas 529's average account holder age being around the age of 42, if I am thinking that correctly. I'm recalling that correctly. So we've really focused the bulk of our campaigns between that 25 and 44, but we also extend up into the 45 to 54 age range as well to really target those younger grandparents and those newer grandparents who are really trying to get in the mindset of contributing to their child's grandchild's education. And kind of getting into some of the improvements and recommendations that we see for opportunities for the future. So one thing that we have noticed we really have been trying to push is LinkedIn. So LinkedIn's targeting capabilities are very, very, very significant in the sense of we're able to target more high-level executives, so people with more than likely a higher amount of income. So we're able to target based off of seniority with the company. We can target based on the specific name of the position that they hold, the seniority they have within the company. So if they're a VP level or if they're an executive level, director level, things like that. It really allows us to focus on targeting those high value audiences within that platform that we know are going to be our ideal audience that we want to drive results with. The second recommendation we want to talk about are search ads in search engine management, search engine marketing. So as we haven't been able to really do very much of this with Arkansas 529, but essentially what search ads are is whenever someone goes into Google and they want to learn they want to learn more about how to change the spark plugs in their car. What do you do if you Google it? Well, it's the same thing for, it's essentially the same thing for when people want to learn how to best save for their child's future education is they go to Google. And this is essentially what search ads are. They're a keyword targeted. It's the only form of marketing that is really at the time where the user is in the mindset of either learning more about a specific industry or product or how to do something, or they're ready to start doing it now. It's very intent-based, it's very real-time, and it's a great way to drive conversions and get some really quick, easy wins in the digital marketing landscape. And this is something that is not currently being utilized by Arkansas 529 today. And the third recommendation is really just focusing more on video content. On social media and across the web in general, we really see just a higher engagement, higher lift for brand awareness metrics with video content. Gathering testimonials from existing account holders could really drive some serious consideration and brand awareness with our ideal audience, and really try to take us and push us to the next level and really grow the amount of assets that are managed. So that's all that we had. Does anyone have any questions that they want to go through?
All right, thank you, team. And tell me the new name. I keep saying NWA Brand, but that's not your name anymore. So talk to us just a little bit about the name change and kind of the new things that y'all are engaging in.
Sure, yeah, thank you. Our new name is Brand Catalyst Company, and it was really inspired just by the fact that when we started, we were really focused on Northwest Arkansas, and that's where I saw the need and felt like that's where we're going to be meeting the need for marketing services. But we find ourselves working more and more with clients who are located in Central Arkansas and also out of state, and so we decided to just expand into that and step into that space of just serving our non-Northwest Arkansas local companies a little bit better.
Cool. Well, as you can see, there is a very collaborative effort with all of our marketing partners, and Census is a key player in that as well. They have monthly meetings to kind of make sure everybody's on the same page. And the biggest thing to me is being able to kind of attack the whole plan from very different viewpoints. Obviously with Brand Catalyst, you've got a younger demographic, where with Vines Brookshire, we're hitting kind of the older demographic and really kind of meeting all our marketing needs. So we're really excited to have them and their expertise. And I've always said, more heads and brains around the table, the better off we all are. So thank you all very much for that. So I'm going to turn it over to Fran for our director's report.
Yes, and I just want to echo what Grant said. Thank you, Kelsey and I, and Bill and Brooke. That was, I think the rest of the committee can see that we're in very capable, intelligent hands. So we appreciate y'all's good work for us. Thank you.
And if y'all need to drop off, feel free to. That's completely fine.
Yeah. Okay. So with regards to 529 day and 529 survey, at the last meeting, I told all of you that we were surveying about 70,000 randomly selected Arkansans, primarily parents and grandparents of young children, to measure their preparedness for college savings. And that survey concluded in April, and we had a response rate of a little over 2%, which sounds low, but it's considered statistically significant. And the survey was compiled, and we worked with Vines Brookshire on that. And we released the survey a few days in advance of 529 day, strategically so. And all of you should have received an email from the treasurer with that report. So you all received it a few days before it went out to the general public and to the media. Is there anybody on the call that did not get it? Okay. So just real quickly, just some kind of high level overview. Going into it, there were some surprises and there were some things that seemed expectant. With regard to awareness, Arkansans are just slightly higher than the national average when it comes to even being aware of what a 529 is. However, in this survey, only 10% of the people in our survey had or have a 529 account compared to the national average, which is around 16%. And then breaking down how prepared they felt they were for college, 22% said they felt they were saving enough, but then 39% said they've saved some but could do better, and then a little under 38% said they're worried they haven't saved enough. So obviously with almost 80% reporting somewhere that they have some work to do, that helps us and helps our marketing team know kind of what our future messages should look like. So if you haven't already, I encourage you to take a look at the survey and let us know either now or later if you have any feedback. So in conjunction with releasing the survey, we also announced a 529 sweepstakes, which is designed to encourage new accounts being opened. So between May 17th and the end of this month, any new account that is opened is eligible for a drawing to win one of five $529 contributions into that 529 account. So what's interesting is circling back here to the respondents for a little bit, what we're going to do, in addition to obviously with the census's help, keeping up with who these new account owners are, we're also going to go back and look at if any of the new account owners are people who registered, who did the survey. So we'll be able to kind of tell if the survey encouraged people, to open accounts. And we did send an email to all the respondents, thanking them for their participation, and then sending them a copy of the survey so they could kind of see the whole full circle here and that this was a legitimate, endeavor that we were doing. Finally, just to kind of put a period at the end of the sentence to finish out promoting 529 day, we pushed out a lot on our social and digital media platforms, as well as had an appearance on Good Morning Arkansas on Channel 7, KARN, B98, and Alice 107 radio stations. Switching gears because it is summer, and with summer comes baseball. And yes, go Hogs, but I'm also talking about the Travs. We've entered into a partnership again with the Travelers, but it's a little bit different this year. But I think it's going to yield us some direct connections to people, probably about 700 people. We are sponsoring the Arkansas 529 Game Zone. And for those of you who are familiar with the Travs, they have these games in between innings, and kids are encouraged to come out and play the games. And so any family or any child with a parent or guardian who goes to sign up to play those games has to sign a liability waiver, but included on that waiver is understanding that their information will be shared with Arkansas 529. So unless they specifically opt out of that, we'll be on a weekly or bi-weekly basis be receiving those names, and they're about 10 to 12 per game, 60 home games. So, you know, we're looking anywhere between 600 and 700 hopefully, you know, people that we can follow up with about the 529 plan. Then finally, we are working with the Office of State Personnel Management on promoting 529 plans to our state employees, so the people in our own backyard, technically. We're working to get in front of the various agency directors, the HR directors at the various agencies, and then also in front of employees through some of the benefits fairs that I think are coming back this fall, not only in person, but then also hybrid. And I mean, virtual. So to help with that, again, with Vines Brookshire, and you all have it in your packet, is a one-pager. It's front and back, but it's still one page. That just kind of gives a quick overview of the plan, how to open an account if you're new to 529, or if you already have a 529, how to set it up so that you can do direct deposit from your state payroll. So I'm going to end with Grant. Did you want to give a brief legislative update, just kind of where we were with the session?
Yeah, so there was only one bill that was related to the 529 education savings accounts. We updated Arkansas law to be in line with federal law. So the biggest kind of impact of that was that college debt and apprenticeships are now eligible expenses out of 529 accounts. So you'll start seeing some of our marketing shift around those message points as we kind of progress and start fully engaging and educating individuals on that. And then the biggest thing is that in the statute, the name was changed from the Arkansas Tax Deferred Tuition Savings Program to the Arkansas Brighter Future Fund plan. So we'll visit that a little bit later, but those were kind of the biggest legislative changes that occurred this past session. So do we have any questions for Fran on her director's report? Right, so now we get to move into the fun part of the work, checks and invoices with Fran.
Yeah, so you all should have received a list of the checks and invoices to be paid for fourth quarter. Do I have approval, a motion? Is that what I need to do? A motion to approve that?
I move that we pay all checks and invoices that are listed for this past quarter and the upcoming quarter.
I'll second.
All those in favor?
Aye.
Then another item regarding contracts. Some of you may recall that we entered into a partnership or a contract with a company called Our College Saver. Well, it's called Invite Education, and we do this Our College Saver website, which is like a one-stop shop for folks looking for tips and resources on saving for education, college search, college scholarships. And we also partner with the Arkansas Department of Higher Ed and Student Loan Authority. And basically the Invite Education people proposed, excuse me, they came to us with a proposal since last year was more or less kind of a lost year. They have proposed tacking on an additional year to our contract, but at no additional funds. So in essence, what was to be the conclusion of our payment for this year, rounding out 2022, they said they would extend it to 2023 and then just divide that final payment and spread it across the 2 years. So we're inclined to accept that and just didn't know if there was any reason you all wouldn't agree.
That sounds great. Yeah, obviously, let's move to approve that contract before they change their mind.
Yeah, so I've got a motion. Is there a second?
Second.
All right.
Thanks, Alicia.
All those in favor say aye.
Aye.
Aye. Okay.
And then the only other item that I wanted to bring before the board with regard to marketing is that it is time for us to start renegotiations or negotiations with Vines and with Kelsey's group. So we just needed a thumbs up from you all that we can begin to have those conversations with them individually.
Yeah, that sounds great. Do we need a motion, Grant?
No, just to get sign off, and then we'll come back before the board for a motion and approval of a contract. We just wanted to make sure that we could continue to negotiate with them moving forward.
Excellent, thanks.
Okay. All right. Is there anything else on you?
No.
All right.
Thank
So
you.
with that, John Peace, let's have a budget report.
All right, thanks, Grant. We've got what I think is a positive budget report. We started off the fiscal year, which was July 1, 2020, with $130,000 in the Southern Bancorp account, which is the primary admin account. At the end of April, we had $115,000 in that account. And I just received the May bank statement, and it shows the balance of $121,000. So we're kind of maintaining that average bank balance. In terms of the actual versus the budget, the Vanguard income is $53,000 more than we budgeted for the entire year. So I think we're going to come out very well. We've got with 2 additional months, I think we'll come out very well on the Vanguard income. On the expense side, the audit fees show that we're $42,000 over budget, but that's only because we paid half of the audit fees for the last fiscal year early in this fiscal year. So that's not really over. It's right on budget. The expenses total are $76,000 currently under budget. We've got 2 months left, so we should come out about even there, I would think. And the First Security Bank balance, we started off with, let's see, actually it has $64,000 less a $33,000 invite education expense. So ending balance was $30,000, resulting in the total admin accounts having $146,000.
All right, any questions on that report? All right, do I have a motion to approve that report?
Motion.
All right, do I have a second? All right,
Second.
All those in favor say aye.
Aye.
Aye. All right, thank you, John. So now we'll go to Dave Ponder with a census.
Hey, Grant, can we do a quick time check? Is the top of the hour a hard stop for everybody?
I'm good.
I'm good.
Okay, I just want to make sure, because I want to make sure John Park had the chance to introduce some new portfolios that we'd like to add in October. So if we're all good, then I'll go through my report. Okay?
Okay.
Let me share my screen. Can you guys see that?
Yeah, there you go.
Yes.
Cool. So before we start, I do want to point out that it's not in the deck, but on the mobile app that we launched a couple of weeks ago where the gift plan was added, we're already up to 1,069 users who have logged onto their gift account through that mobile app. So that's phenomenal usage. Great job.
How have you seen that experience rate with other states that you've rolled out?
Sure. Yeah. So, the states have rolled out at different times, but the uptake that I'm seeing from gift is right up there with the best of them. So that's fantastic.
Good.
Yeah. So Bill had alluded to the asset levels that you guys are at. I did want to point out that right now, if you look at the total trust, the gift and the iShares plan, you guys are at $1.22 billion. So you guys are blowing it out of the water. This is fantastic. So let's talk about the gift plan right now. So you're at $567.6 million as of the end of May. What a recovery you guys have had from this dip from when we're looking at last March, or rather March of 2020. It's just truly amazing how quickly this has recovered. Any questions on that chart? So, and I also want to point out, I give this report in calendar year, not your fiscal year. So I'm looking at 2021 contributions calendar year to date versus the same time period last year. So when we look at year-to-date contributions in the calendar year, we're over $26 million so far in inflows. That's 18.8% over where we were at the same time last year. Now, again, we were in a bit of a pandemic last year, but still we saw fairly steady inflows at that time. So when we look at withdrawals for 2021, we are about 14 million over what we saw in 2020, but I want to point out that the good news is that 84% of all the withdrawals that you see here are qualified. The only non-qualified withdrawals only made up 5% of the withdrawals. So people are using the money for what its intended purpose is. So when you do the math, net inflows amount to 9.78 million. That is a 24.5% increase over the same time period during 2020 calendar year. We look at funded accounts. We're standing at 32,062 funded accounts as of the end of last month. And these lines are parallel. I mean, the growth is steady and as you could possibly be. The average funded account size stands at over $17,700. And when you look at that broken out by Benny age, you see that it certainly skews the higher amounts for the ones who are getting ready to use their money. You know, one thing I know that I think Bill was mentioned, you know, really looking at the average age of the Benny. I think I'm going to add a chart in here moving forward to track the average age of Benny in the gift plan so we can see how that looks. And then turning to iShares, I want to, again, still John's thunder, but we're over 653 million in assets as of the end of May with over 15,000 funded accounts with a whopping average account balance of over $43,000. And then lastly, just touch, was there a question? No. So UPromise and UGift, we've seen over 8 million in UGift contributions for the gift plan, almost 3 million for iShares, over 14,000 gifts for the gift plan, over 2,500 for iShares. Average gift amount for the gift plan is almost 600. The average gift amount for the iShares plan is over 1,100. And then real quickly on UPromise Rewards, we're closing in on $2,000 of free money coming from these corporations. With that, I'll close and ask if there's any questions.
All right. Thank you, Dave. Always appreciate the good news you bring. So with that, we'll turn it over to John Park with iShares.
Thanks, Grant. I am going to share my screen. Okay, can everybody see that?
Yes.
Okay, awesome. So yeah, picking up from where Dave left off, we have had pretty significant account growth, really rebounding obviously from the lows of the pandemic. And you could just see at the top of this page that not only have we just had pretty remarkable growth this year, 11% increase just in the first 5 months of the year, but you know, just steady growth ever since we changed the structure of the plan to allow broker-dealer share classes, right? So at the end of 2017, we were just a little bit above $400 million. We're at 600 right now. So that is a pretty amazing growth. To talk about what's going on in Arkansas through May 31st, we have also had significant growth since the beginning of the year. Total assets stand at 55 million right now. That's 21% growth, which is pretty amazing. Also, more financial advisors have come on board, as well as account numbers increasing and the average account size also increasing as well. So you can see, you know, just in the state alone, we have 162 advisors at Edward Jones. I just looked at that since the last board meeting, and that's bumped up quite a bit. So we continue to have good traction. The word continues to go out within the state of Arkansas. Firms continue to come on, and we're really excited about that. So I know.
What are the green?
The green are new firms. Yeah, okay. So green notable firms. And these were the same firms as the last board meeting, but the green firms are Cetera, Equitable, Goldman Sachs, and Stifel. And the reason why I highlighted those are because those are large national broker dealers that have a footprint not only here but everywhere else as well. And the fact that they've come on and started opening accounts within the state is a really positive sign, right? So not only do we continue to have good penetration in terms of the relationships that we have, but the breadth of the relationships is also increasing. And that's what we're really going for at the end of the day. We want every single broker dealer that is doing business within the state to be offering this plan, because at the end of the day, it's the best plan to offer with all the state benefits that you and your team have been successful in increasing for Arkansas residents and investing either in the direct or advisor sold plan for the state. So one, as Dave alluded to, one bit of new business that we wanted to discuss was that we have been contemplating for a long time, and you might have seen some headlines in the news about BlackRock's focus on sustainable development, being a good steward in the investment space, not only to clients, but just, being a good corporate citizen in general. And we have Sarah Shellberg with us, who heads up the ESG investing product line for iShares, to discuss some exciting new products that we're proposing that we add to the iShares plan, which will really differentiate us from other advisor sold plans. BlackRock has really been a leader in this space. We have had conversations with tons of financial advisors and clients that have been asking for more options in terms of ESG investing. And we feel that making these additions, and we're still discussing the final lineup with Ascensus in terms of how many we're going to bring on board. But adding these investments are really going to differentiate the plan from other advisor sold plans and give us a real leg up in terms of competitive advantage, and also just meeting the need that we're seeing in terms of questions from financial advisors and demand from clients. So Sarah, I am going to hand it off to you.
Perfect. Thank you, John. Hi, everyone. Thank you for the opportunity to be with you today. I'm really excited for an opportunity just to talk with you a bit more about sustainable investing. And, as John alluded to, we're seeing a lot of interest, particularly from advisors, around sustainable investing and particularly ESG ETF options. The genesis of this actually was from a conversation that I had with one of the largest wealth teams at UBS, who basically said, we have your 529 plan on our platform. However, there are no ESG ETF options. And so we can't necessarily meet the demands that are, from our clients. So we believe there's a real opportunity, as John mentioned, to really differentiate the plan and looking across the options that they have at the firm. There were no other, platforms and plans that really offered ESG. So with that in mind, and I know that we're already at the top of the hour, I will try to keep this fairly brief, but certainly do stop me if you have any questions. I'm really just going to touch on at a high level, really three things, which is why sustainable investing. Two is just to provide you a bit of a broad overview of what the landscape looks like today. And then finally end with a very high level overview of some of the products that we are proposing. So let me just share my screen. Let me know if you guys see that.
Yes.
Okay, perfect. Okay, great. So as John mentioned, right, so BlackRock, we've been quite vocal around sustainable investing. And as some of you may be familiar with Larry Fink's letter to CEO, we've more recently published letters from our Global Executive Committee to our shareholders, And last year, we made a pretty bold statement about sustainability being our new standard. And then this year, we really, focused in on particularly climate and our commitments around net zero. And as really the largest fiduciary in the world, our strong belief is that integrating sustainability insights is really consequential in helping our clients achieve long-term value. So as we look at this slide, you can see there's a lot of numbers on here. It really is designed to provide, again, kind of this broader picture of some of the real key forces that are really driving what we're calling a tectonic shift. Starting from the left-hand side, we're seeing more and more availability of data. The data is allowing us to collect more systematically some of the insights that were really just, you weren't unable to gather that insight unless you were a Wall Street analyst talking directly to companies. You think about the enormity of climate change, right? So we talk about, some of these billion-dollar weather events that are, costing about $80 billion a year. And we really kind of refer to that of the fiscal risk and how that really impacts companies. And then individual investor preferences. So, we cite a test that was done by Morningstar. They partnered with MIT to basically run a cross-section of the US population. And instead of asking survey questions where there tends to be bias, they actually ran a test to see what would you choose if you knew more about that company from a sustainability perspective. And actually 70% of Americans actually said that they would choose a sustainable option. Actually 40% actually strongly believe that they would choose a sustainable option. And then finally, obviously what we're seeing globally around institutions who are really embracing sustainable investing. I'm just going to point to at the bottom of the slide there in blue on the right-hand side. It's 103 trillion, which seems like an outrageous kind of number to comprehend. But what that represents is the actual assets that are managed by, over 3,000 signatories to the UN's Principles for Responsible Investment, of which BlackRock is a signatory. What that means is you've got, pensions, you've got, wealth, all the way to wealth firms who committed to integrate ESG into their investment process, as well as report out on it. So that hopefully just kind of level sets in terms of some of the actual kind of forces and the tailwinds that we're seeing around sustainable investing. Real quickly on this, it's basically just just to show that at BlackRock, we believe actually indexing is going to be a significant force and really continuing to drive sustainable into the mainstream. So much so that we anticipate over $1 trillion in assets before the end of this decade. And you can see in the green and the pink bars, it represents index mutual funds and ETFs. So I won't go too much into this. I think, broadly speaking around, again, some of the forces, it's that if you think about some of the data piece of this, right? Technology, data, that is giving us greater insights to create even more robust indices. And if you think about sustainable investing, people call it socially responsible, responsible investing, impact investing. It was really focused, on the largest investors in the world. And now with the proliferation of data, indices, ETFs, it's really giving investors more and more choices for their portfolios. So just to give you a sense of what we're seeing within ETFs, you can see in the green bars there, right, back in 2015, 2018, right, we were seeing some growth. It was quite kind of steady growth, but you could see a significant pickup happening in 2019. And then also year to date, we've already far surpassed the full year, right, in terms of flows into sustainable ETFs. You can see in terms of the category itself, we're looking at a CAGR around 80%. Versus when we think about the overall ETF market, we kind of think, wow, it's growing at a pretty significant clip. And in comparison to that, it's about 21%. So just to give you a sense of the, kind of the players within sustainable ETFs, you can see a number of our, competitors listed here. iShares launched the first sustainable ETF actually back in 2004. I would say that, we really didn't put that much more of a commitment to sustainable ETFs. I would say probably back in 2016. Today, we have the broadest and deepest product set, and I'll walk through that in a moment. We have today currently roughly about 60% of the overall market share. So let me get a bit into kind of the what around sustainable investing. And, at a high level, you can see the definition, at the top there, which is when you think about sustainable investing, really what it is, it's a combination of traditional financial analysis with non-financial analysis with insights about the environment, the society, and governance, right? So it's really a combination of the two. And so it's really about bringing in financially material insights to drive a better investment process. And so the bottom half of that screen in that grid here is really, kind of the framework as we think about the various different solutions. And it's really designed to capture investor motivations to either avoid or advance. And so what I'm going to draw your attention to is really what you see in blue there. I'm going to talk a bit more about ESG, which is really, the data toolkit that helps to inform some of these insights. So around broad ESG, taking a look at, of course, you can see this is our entire platform here. Under the shaded light blue there are optimized ESG products. So these are the products that we are going to be providing as a proposal. These are our largest suite of ETFs with roughly about 35 billion in assets. And so we offer equity and fixed income funds. What you see in the gray there are actually one ticker solutions that are based on different risk profiles, utilizing the underlying tickers for the asset allocation. So let me pause here just for a moment. I'll get a bit more into the products, but any questions so far? No? Okay. Let me just quickly touch on what we call our ESG Aware suite. So ESG Aware is really designed to provide investors with a similar risk return profile as a broad market. We call it tracking error. We keep it pretty tight to the actual market cap weighted benchmark. So investors can really think about these as asset allocation building blocks in their portfolios. But we're also integrating, the ESG data into the security selection. And so as a result of that, what you can see here is that the ESG Aware ETFs provide 23% higher in terms of overall ESG score with a 35% reduction in carbon intensity. It also applies 5 business involvement screens that includes controversial weapons, civilian firearms, oil sands, thermal coal, and tobacco. So I won't go too much into some of these details, but let me just stop at this slide here, which is our ESG Aware allocation ETF. So you can see, right, in the way that we've designed the suite of products is that it covers a broad, diversified exposure across equities. We've got, large, mid cap, small cap, international developed, emerging markets, corporates, and a broad Barclays aggregate exposure. We also combine them, as I mentioned, into one ticker and offer them as across the various different risk profiles to give investors kind of a simple, again, diversified one ticker solution. So let me pause there. Went through a lot. Any questions? Otherwise, again, I know we're short on time, so happy to stop there.
Are there any questions on this? All right, thank you. I think the committee, Clint, I'm sorry, you unmuted. You have a question?
No. I was just being prepared if I needed to talk. So.
No, okay.
Grant, one thing I did want to ask about. So we're asking permission to add at least 4 of these ESG portfolios in October. I do think we'll need the committee's permission to do that.
Yeah, and I don't think the committee is at a point right now to make that decision. So I need to, from at least our office's perspective, need to do some more research on this. ESG is a very controversial issue. It is something that the legislature has kind of weighed in on, and I've got to kind of run some traps and just be respectful of the position that the treasurer does hold. But again, that's only one voice on this committee, but just not having really looked at this a lot in advance of this meeting, going to need to dive in and do some research on that. I don't know, Clint, do you have any perspective on that?
No, I would echo exactly what you're saying. A lot of discussion around ESG right now. So
very good. Thank you.
With that, Julia, do you want to jump in on your report?
Yeah, nice to see everyone. Thanks for having me. Let me see if I can share my screen as well. Can you all see my screen?
Not yet. There you go. Now we see us.
Okay, great. So I know we have limited time, and I did share our Vanguard economic and market outlook with all of you. I think there are only two things that I want to point out with respect to moving into the first quarter of 2021 versus what we shared with you earlier. That's with respect to our forecasts on U.S. growth and U.S. inflation. So we have certainly upped those numbers based on the accelerated pace that we've been able to approach herd immunity, the vaccination rate, and also the fairly static rate with respect to those reluctant to get vaccinated. So based on the increased speed with which we're overcoming COVID and we're returning to normal conditions, we certainly upped our base case and upside growth rates. 7% is our best base case now, and 7.8% for U.S. growth for the year would be our best case. Similarly, with inflation, I think we still feel there'll be a spike in inflation in the second quarter of this year above the Fed target, but we still see the year ending at or close to the Fed target of 2%. However, the probability of inflation, that spike in inflation persisting and us overshooting the Fed target has increased. So there may be an opportunity to see that prevailing higher inflation through year end in 21. We didn't quite feel as strongly about that when we last spoke at the end of 2020. Those are the only two comments I really want to make with respect to our forecasts. Does anyone have questions with respect to that? Okay. Let's talk briefly about the performance of your age-based portfolios. So again, as you know, when we met last time, I did speak to some fairly substantial performance differential with respect to especially your equity-heavy portfolios. That was due mostly to the historic and extreme volatility we saw in the first half of 2020. However, as we moved into first quarter of 21, you'll see with respect to especially, again, the equity-heavy portfolios, aggressive growth, blended aggressive, the first few portfolios you can see here. If you look at the one-year performance, we have definitely reverted back to more normal performance differential with the composite benchmarks. And if you look at even shorter term returns, 3 month and 1 month, we're tracking much more closely. So I think we feel that the portfolios have reverted to more normal performance patterns, and we expect them to continue to perform as expected as we move into 2021. Similarly, with your underlying funds, our basic broadly diversified index portfolios, those funds continue to track quite tightly with their benchmarks. Overall performance looks to be as expected. Any questions on your first quarter performance then with the portfolios? All right. The last thing I did want to talk to you about is just give you a quick update on our target enrollment portfolios. I didn't provide any materials in the deck, but just wanted to give you a quick update. As you know, we presented our target enrollment portfolios to all our municipally advised states in 2020. As an option, not as a recommendation formally, but as an option to your existing age-based portfolios. The basic difference is that an investor in your age-based portfolios has to identify their risk profile or their risk tolerance and then picks a track, conservative, moderate, or aggressive based on that. With our target enrollment portfolios, there's one choice, one portfolio, and that's based on the age of the beneficiary. In addition, the additional difference is the actual allocations of the glide path. In your existing age-based portfolios, those allocations are really stepped. They're 12.5% on an annual basis. The equity is reduced, or as we call it, de-risking. With the target enrollment portfolios, those allocations are much more frequent and have a lesser degree. Those allocations are reset every quarter. So in fact, the glide path of the portfolio is essentially smoothed. There are two real perceived benefits to this new glide path methodology, the progressive smooth glide paths over your existing age-based. The first is really investor-based. It's a much more transparent, easier decision for your account owners. They identify the age of their beneficiary and they pick the aligned portfolio. That's it, one decision and they're done. With respect to your age-based currently, they sort of have to figure out where they stand on the risk spectrum. And then once they've decided that, then they pick the track that they want to be on. So as we all know, with respect to investor behavior, the less decisions they have to make, the less impediments to making the decision, the better. And so we feel that this one decision, one portfolio solution enhances the ability of the plans to engage their account owners and get them to make the decision to enroll. It's all about getting them into the product. It's all about getting them enrolled. The second benefit is really less overt. It's the investment case. We certainly feel we continue to optimize the wealth accumulation and risk mitigation of the asset allocations in this glide path. So from an investment outcome perspective, we do feel that there is some additional benefit to the new target enrollment portfolios. The asset allocation falls in between your moderate and aggressive age-based tracks, and we feel that we've sort of continued to hone in on the sweet spot for the largest percentage of account owners with respect to their wealth outcomes versus their risk exposure. So that's just the difference between these two products in general. From a landscape perspective, as I said, we introduced them to all of our advice clients last year. We converted the Vanguard plan in early November. The Pennsylvania 529 converted at the end of April. We just had a third state vote to approve, and they will be converting sometime in early 2022. And we have several more states who are in the process of vetting and evaluating, and will probably come to a vote sometime later in 2021. And then from higher level, the entire 529 landscape, this is certainly a dominant theme. Over 50% of the direct plans already have a progressive glide path. This trend is continuing to increase. As you may know, TIA converted all their age-based portfolios to target to a progressive glide path in 2020. So we do see this trend continuing, and we expect more states will adopt and convert. And then finally, Morningstar, from their perspective, they've embraced this new glide path methodology, and they do consider it an industry best practice. So I just wanted to give you a quick update on that. Obviously, I can answer any questions you have, and we can certainly set another time to talk about this in more detail when you feel it might or should be of value to you to take a closer look. Any questions at all on what we've discussed?
Hey, Julia, what's the implementation timeline for the progressive glide path?
At least 3 months, and that's something that we would partner with very closely with the census on and scheduling it in their project pipeline. But certainly, if you can give yourself 6 months, that's probably a good idea. At least 3 to 6 months, probably 6 months from the time you decide to the time we can actually implement. Obviously, we'd want to share with you, communications program, timeline, as well as spend significant time with you on your mapping decisions. That takes a fair amount of consideration, and you probably want to seek approval on that. And then finally, the actual implementation project plan with the census.
Yeah, granted.
Jay, do you want to weigh in on that?
Yeah, it's obviously, as we mentioned, there's a couple plans that will be converting. It is a fairly heavy load. Right now, I think the timing would be sometime in 2022.
Mm-hmm.
Okay. Clint, Alicia, any thoughts on Vanguard's report? Any questions?
I don't have any questions.
Nope. Sounds good.
Thank you, everyone.
Hey, Julia, I do think by the next committee meeting, if we haven't had a special meeting, probably would put that on the agenda to dive into a little bit deeper and have that conversation. Dave, do you think that's fair?
Yeah, I think so. As long as we keep in mind that we're really talking about next year to get it done.
Correct.
If we can get approval and get it in the queue, the better it will be. I'll immediately submit a project request to get it in line.
Yeah, and just for the board's sake, my 2 cents is Morningstar, they did bring this up in our last review. We were upgraded in our last review. I would just like to be able to go into that review, having the board make the decision to move forward with this, get with industry best practices so that we continue to move back up the ladder with Morningstar. That is kind of an important, although aggravating thing in my mind. I do want to make sure we're able to continue to show improvement with Morningstar.
Well, Grant, I'll definitely make sure that we include this discussion, a deep dive on this at your next committee meeting. And in the interim, Fran And if there's anything that you need from me with respect to information or previous discussions, just let me know and we can get started on it.
Sounds good. Thank you.
Thank you.
All right. I've just got one bit of new business, but I'll pause if there's any other business that we need to address before we adjourn. All right, seeing none. So with the legislative change and the name change of the program, that has afforded us the ability to have a new brand or a new name to the marketing and program on the Ascensus side. So with that, I kind of want to open the conversation up. I know that Fran and the Ascensus marketing team and legal and compliance team have kind of batted around a few ideas. So I'm going to open the conversation for Fran and Dave to kind of go there. And hopefully we can get approval from the board for a name change before we adjourn.
So Dave and his team have been working, like Grant said, with us on some names, and I've worked with John Peace as well on, doing some preliminary research on some of these names. But Dave, do you want to spend just a minute kind of giving us an overview of where things are now and what that implementation would look like?
Yeah, I think, and again, ultimately it all hinges on the final decision by you guys on the name change. I think the last thing we were looking at doing was having a conversation around whether we register the name, but and the use of the word fund, I think, is probably out there as well. And I don't know how deep you guys want to go into this conversation on the actual branding. You tell me. Do you want to have that discussion here, or do you want to have that outside the board?
No, I think we're at a point that the board kind of needs to hear the work that staff has done and weigh in on where it would like to go.
So I think the thing our team was hung up on, and it's not a huge hang up, but it's the use of the word fund in the branding. So 529s are kind of a complicated product in some ways. They're simple in others, but they're fund of funds, right? When you own a portfolio, you don't actually own the mutual fund that makes up that portfolio. You own units in the portfolio. And so when you use the name fund in the branding of the 529 plan, there's a little bit of concern that you might be making people feel like they actually think they own a mutual fund, which would not be the case. So I think that's kind of where we are on the branding concept, and everything else is approved. But I don't know. What do you guys? I mean, is using the word fund in the branding something that you guys feel like needs to happen? How do you guys feel about that?
I personally, I'm not hung up on it. I think my intent originally was to try to mirror what the legislators kind of picked and went, but I'm not, hung up on that at all.
And I think, I'll own, I think I was the one, and Dave in that last email, was just saying we had recalled there was some discussion about fund versus plan, but didn't know if it was a preference thing or a legal thing. So it sounds like, we just take fund off the table. And I think we also were interested in some continuity between like Brighter Future Direct Plan, Brighter Future Advisor Plan. So we're connected, but we're also more descriptive in the two different plans. Because iShares doesn't.
Right.
You have to know what that is to know what that is.
Exactly. Well, so ultimately the decision is yours. There is no compliance. There is no official compliance pushback against using fund in the name. It's just the legal team has raised that as an issue that could cause some sort of confusion on behalf of the account owner. If you are like, if this is the way you want to go, we will accommodate that branding using fund. Again, the preference is not to, but ultimately the decision is yours. I just want to make sure you're completely clear on that. This is your plan. We'll do what you choose or decide. I'm
sorry, Dave, pause right there. I think the first question before the board is there a desire to use the word fund, or are we okay sidestepping it and going and not using it?
Well, I hear exactly what Dave's saying as far as that, there's legal issues, and confusion around the word fund, because fund's a term of art that, but I really like the idea of going forward with brighter futures. That's a very positive and descriptive, much better than iShares. That's my opinion. I'm indifferent whether we use fund, plan, or whatever at the end. I think the important part is to use brighter futures.
Yeah.
I'm indifferent really about plan versus fund, or if there's even the possibility of just leaving that off, just a shorter branding title.
Okay.
So
I think there is an organization called Brighter Futures.
It's a scholarship.
There is a scholarship or an education. So
that could be an issue. Yeah.
Right.
But it's not. Is it in Arkansas?
No. Well, yes, but it's not. They support people it's like a scholarship. You have to apply for it, but it does not directly compete with us. And so all the more reason to have plan on there to differentiate.
All right. So I think we're in accordance to drop the word fund.
Okay.
And then Alicia, did you have anything to weigh in on that?
No, I was really just kind of thinking about if you dropped the word plan or fund, if you wanted to somehow incorporate Arkansas back into it, but that may go against, that may not help make you a distinction without a difference, if you will, between what
and our intent is to have Arkansas on the front of it.
Yeah, Arkansas.
So it would be the Arkansas Brighter Future Plan.
Okay.
And that's for the direct plan, correct? And for the advisor plan, you would not have the branding of the state, correct?
Right. It would be Brighter Future Advisor Soul or Advisor Plan or whatever it was. I'm sorry.
Yep.
Yeah, because on the national side, you want to drop the state.
Yeah.
So that you have that national reach to it. And our advisor is the national reach.
Yep.
Okay.
So
John Peace, I know you have done some quick kind of legal. Did you have any, from your perspective, any legal concern with Brighter Future?
No, I think we need to use the word plan with it, but I would advise against using the term fund.
Okay.
Thank you. Okay, so the timing on this is obviously we need a final decision on the branding for both plans. We're working hard on our side to start making the changes internally for both the gift plan as well as rebuilding. So years ago, we were a co-distributor for the iShares plan. We actually hosted the website. We're going to be taking the website back and putting it back on our platform, as well as doing the rebranding. So those internal conversations we've had probably 6-7 meetings at this point. We're trying to work the two projects together, and things are moving quite well, and they're going to move very fast. So as you know, I'm not sure exactly what the timing is to have a final decision, or I think Grant, you said you want to leave today with a final decision on the branding of both plans, correct?
Yeah, that's what as long as I can see some positive responses from Clint and Alicia, I think I've got a motion ready for them to consider.
Okay.
All right. So with that, I would move that. Hold on, I'm getting my words right. All right, I would move that we rebrand the Arkansas 529 plan to the Arkansas Brighter Future Direct Plan and the Brighter Future Advisor Plan. Do I have a second?
I'll second that.
All in favor, say aye.
Aye.
Aye. All right, there you go, Dave. You have final sign off.
You have you've taken off all the ropes now. We're ready to go. So that's pretty good. So we'll start the process again. January 1st is the live date that we're shooting for. So everything should be in place by then. We are having some John Peace, just for your information. We are deliberating internally whether we do a complete program description rewrite for the gift plan. We are actually in the final stages of doing the rewrite for the iShares plan. And of course, we think we're going to go ahead and launch the updated iShares program description without the new branding in it, and then we'll supplement the new branding as we get closer. But for the gift plan, we're deciding whether or not to do the rewrite or just put a supplement on top of it, and then do the rewrite later in 2022. So that's kind of where we are. But this is great news. Congratulations on your new branding.
All right, thank y'all very much. I know we went a little long today, but I appreciate everybody's input and
in-person, hybrid.
Oh yeah, so moving to our next meeting, is scheduled for August timeframe. So that we would be looking at our August timeframe for our next quarter meeting. I know we have started doing some committee meetings back in person for boards that the treasurer sits on. Is there a desire to go in person for our August meeting?
I'm 100% fine with showing up in person. Not a problem. Short walk for me. So.
I think it's a bit longer for me, and I certainly would not be. I'm thankful for Zoom today, but I'm having no problem with in person.
All right. So we'll just kind of, John Peace, are you good with in person?
Oh yeah, that'd be fine with me.
Okay. I think I talked to Dave a little bit. Hopefully he'll be clear to kind of come. Julia and John, I know if there's still some restrictions or whatever that you might have from, Vanguard and BlackRock, obviously we'll Zoom y'all in. But I think the desire will be to try to do it fully in person in August.
Awesome.
Okay, thank you.
Our guidance is changing, pretty quickly, so that may be possible on my side, but I'll let you know for sure.
All right, sounds good.
Same here.
Thank you all very much. I appreciate it. And with that, we stand adjourned.
Thank you.
Thank you, everyone.
Thanks. Goodbye, everyone.
Thank you.
Bye-bye.